The following paid commercial program is brought to you by TD Wealth.
Hello and welcome to Money Talk. I'm Kim Parley. Thanks so much for joining us. At one time, it might have been unthinkable, the idea that anything other than the US dollar could be the world's preeminent currency. But some say de-dollarization is not only happening, but could be accelerating as the global use of China's renminbi rises. My next guest has written a report on the subject called Dedollarization and the Rise of RMB as a Global Currency. Kevin Hebner is Managing Director, Global Investment Strategist at TD Epoch, and he joins us now. Kevin, it's great to have you with us. Great report.
Hi, Kim. Thank you very much.
Let's start with the conclusions in terms of, because for people watching, impatient investors, we want to know what it all means. Tell me what the conclusions of your report is, and then we'll get into the reasons why.
Well, I think the big picture is that we're moving from a unipolar world that's dominated by the US dollar and its financial system, and we're moving to something which is more bipolar, and we're being in a world in which the renminbi has a bigger role, and that's reflecting the bigger economic heft that China has in global trade, global economics, and so forth.
Yeah. So the de-dollarization means that, again, it's this bipolar world, another currency gaining acceptance, gaining strength. You also mentioned, though, that, another byproduct of this we could be seeing, and again, predictions, we have to kind of wait and see how the world unfolds. We could see stronger gold and we could see a weaker US dollar.
Yes, certainly the U.S. has this exorbitant privilege, which means a lot of money goes in the U.S. dollar assets. That makes the dollar strong. It also keeps interest rates lower. And this new world we envision, where it is going to be more difficult for the U.S. to fund their big deficits, interest rates could be higher, say by 25 to 150 basis points. The U.S. dollar, we think over the long term, will be about 20% cheaper. And then gold, at least during the transition period, will be viewed as an alternative type of reserve currency. And we certainly have seen over the last 10 years a real bid from a number of countries for gold for these reasons until the renminbi is ready in all the different aspects of plumbing to be in a position to challenge the US dollar as the predominant global currency.
And just to be clear, we're not talking about this happening tomorrow. This is going to take some time.
It takes a very long time. So, for example, the U.S. became the largest economy in the world in 1870, just after the Civil War, but it didn't become the global reserve currency until immediately after World War I. So that was a period of 40 to 50 years. So these things move very slowly.
I want to, again, we're going to dig into the reasons, because you've put together a very detailed report, I think, explaining it. But one thing that is notable to me is that I think a lot of people have been hearing this for a while, and I think there's a lot of skeptics that this could actually happen. Yes. So maybe you could just start by telling us, what has been the U.S. history of getting dollar dominance, and why the skeptics maybe are not seeing what could be happening.
I think for a lot of the skeptics, they're looking and they're saying, well, what is a global currency? And certainly for everyone who's alive today, they only really know one global currency, and that's the US dollar. And they say, well, to be a global currency, you need to have a big current account deficit. So there's lots of money coming in. You have to have enormous capital markets, the treasury market, equity markets, venture capital, private equity, all these things. You need to have an open capital account so money can go in and out freely. So all different aspects of the US dollar financial system. But that's based on a set of one. So one example, and people are extrapolating from that, where we think this new global currency is going to be one with Chinese characteristics. And it's going to look quite different from what the US dollar has been over the last 50 years, or before the US dollar, when sterling was the global currency.
It's interesting, too, because you mentioned, and it's funny, I've never heard it talked about in this context, about the network effect that happens with the US dollar, which is part of the reason that it has the strength that it does right now. Maybe I've heard about it with internet and with viral things on that front, but how do you see it, and how does it help?
Well, I think, if you don't mind my going on a little bit of a tangent for network effects, because they're quite common in digital economies. So, for example, I use Twitter a lot, and Twitter is a place where there's a lot of content, and there's content providers and content consumers, and you have this sort of two-sided network effect. And now some people are moving towards Threads, and Threads doesn't have some of the features that Twitter has, but it also doesn't have an owner who wants to tax or penalize both the consumers and producers of content. So people are moving to this different platform. And I think it is similar. The US dollar has all these network effects. So once you become dominant, you have all these features. People are issuing US dollar assets. People are buying US dollar assets. And then there's all the different parts of the plumbing that go associated with that, the regulatory parts with the Fed and the Treasury, the interbank payment system, the messaging system, all the different types of markets, offshore markets, onshore markets. It's very complex, and you need both sides coming to it. And that takes a long time to build up. And it's only been, I'd say, the last 15 years that Beijing's realized the importance of building up all this infrastructure, all this plumbing, to ensure that they do have sort of the two-sided network effects that are necessary to attract both providers and consumers, in this case, not of content, but of capital.
All right. Well, and yeah, it's a great example of, strength begets strength. And it kind of, becomes those things that people want to use more and more. Yeah. Just to give us a little taste, if you would, because we're going to get into more detail. That's part of the reason why you see that China is growing dominance, but also the fact that the U.S. is weaponizing the U.S. dollar.
Yes. Yes. And so the U.S. has about 10 times more sanctions, financial sanctions, on different entities than it had 20 years ago. It has 6 times as many sanctions on sovereign countries as it did 20 years ago. So the U.S. has really decided to ramp up financial sanctions, and they're doing that, one, is because the U.S. dollar financial system is so dominant, it's so powerful, people need access to it. They're also doing it because to replace, for example, trade sanctions. Trade sanctions are problematic. They do hurt U.S. producers, sometimes U.S. consumers. And also, if you sanction, say, a country like Iran, you end up often hurting disadvantaged people in Iran, people you don't want to be hurting. Whereas financial sanctions, you can target the entities, and they could be political, military, corporate, financial entities, individuals that you want to target. So it's much more precise. And to some extent, it seems like a less painless way to inflict sanctions. And over the last 20 years, really since 9/11, this has been accelerated in the U.S. And there's some good aspects of that. But for a lot of countries, they're looking and they're saying, well, I could be next. I could be the next Russia, Iran, Venezuela, North Korea, and so forth. And I need to protect myself, or at least de-risk from this vulnerability. I need to have access to an alternative financial system than the U.S. dollar-based one.
All right, well, stay with us. When we come back, we're going to talk more with Kevin Hebner. We're going to dig into exactly what he's alluding to, the details as to why this is all happening, and understand just what the implications of that could be. You're watching Money Talk. We'll be right back.